Greetings to Professor Dr. Wong. We are from Group 10. We'll present about discuss managing credit analysis. Now, I will present question 17, which is consider a filing bank. How much is a deposit of 260,000? What if the FIDIC use the payoff method, the purchase and assumption method? Which method is more costly to taxpayer? So, the answer for this question is on the payoff method. The FIDIC allows banks to file and pay deposits up to the insurance limit of 250,000. So, in this context, the depositor will lose the unprotected portion of his money, which is 40,000. However, account holders with deposit above the 250,000 limit usually get back more than 90% on the dollar, although it took several years to complete the process. So for the second method is the purchase and assumption method, where the FIDIC is said to restructure banks, usually by finding a willing merger partner bank that assume take over all the liabilities of the failed bank so that no depositor or other creditors lose a cent. Thus, through this method, the FIDIC will guarantee all liabilities and deposit without insurance limits, as in this case, the account holder has a deposit of 290,000. Depositors will not lose money because the taking over bank will continue to hold this deposit as usual. So, to answer the question which method is more costly to taxpayers, is the purchase and assumption method is more expensive to taxpayers because the FIDIC has to bear the additional cost of ensuring that other banks are willing to take over the deposit and asset of failed bank. In this context, the FIDIC will use its means to attract other banks to become partners, such as providing incentives, subsidies, or absorbing assets from failed bank. As a result, the FIDIC will bear additional costs such as administrative expenses and subsidies that make this method more expensive, especially when the FIDIC does not have enough fund to cover it. Therefore, the taxpayer will bear the cost. That's all from me. Thank you.
For the question 18, the question asking for calculate the bank capital ratio before and after the agreement. Also calculate the bank risk-weighted assets before and after the agreement. So my answer is, for bank capital ratio, using formula bank's capital divided by total asset. Same for before and after the agreement, the result is 6 divided by 96 equals to 6.25%. For bank risk-weighted assets, before the agreement, the total is 39 million, and after the agreement, the bank make a loan for 15 million loan. So the result is 39 plus 15 equals to 54 million.
So I will present the question 7 is the invention of the computer is the major factor behind the decline of the banking industry. Is this statement true, false, or uncertain? Explain your answer. My answer is uncertain because the existence of non-bank entities due to the many financial engineering inventions like securitization and shadow banking systems. The non-bank financial institution to conduct credit risk evaluations in a controlled and low-cost environment, thereby nullifying the traditional primary edge that banks had when it came to providing loans. Other significant factor, the shrinkage of the traditional banking industry cannot be blamed on computer science. Regulatory changes, liberalization of financial markets, and the emergence of new forms of financial markets such as the junk bond and commercial paper markets led to enable direct capital raising and eliminating bank intermediation function. And the last is challenges in revenue bank, lower profitability resulting from standard banking activities has led this institution to seek new areas of profitability investment in high-risk activities, as well as of balance sheet transactions are some of them. That's all from me. Thank you.
Good morning. My name is Mohammed IKRAM SAAD, and I will be presenting the answer to question 9. Question 9. How do sweep accounts and money market mutual funds allow banks to avoid reserve requirements? Banks use sweep accounts and money market mutual funds in order to reduce their reserve requirements, thereby maximizing their allocated financial resources. Reserve requirements fix that banks must hold a certain percentage of deposits in reserve rather than lending them out or investing them. By employing sweep accounts, the banks can transfer the excess funds from checking accounts, which is subject to reserve requirements, to either the MMDA or other saving accounts. This process is usually done automatically, depending on certain balances predetermined by the bank, ensuring that funds are moved efficiently to reduce the amount of required reserve. Money market mutual funds are another way for banks to go around reserve requirements. These funds invest in short-term liquid stuff, and this offers banks a way to earn interest on excess funds that would otherwise sit as non-interest-bearing reserve. Investing in these funds allows banks to earn returns on otherwise idle capital while also maintaining liquidity. Overall, these strategies allows banks to maximize their profitability by reducing the amount of funds tied up in reserve and increasing their investment in interest-earning assets. This approach enables the banking industry to enhance their issues-based financial returns without compromising compliance level. That's all from me. Thank you.
So for the question number 13 is, why have banks been losing income advantage on their asset in recent years? So there are 4 factors, which is, first one is the financial innovation and the decline of traditional banking innovations. Financial innovations such as junk bonds, securitization, and the commercial paper market have led to banks in declining net income. Junk bonds, high-yield bonds issued by firms with lower credit ratings, allowed businesses to bypass banks and access public market for this funding. This shift reduced banks' interest income from loan and led to a loss of profitable segment of their clientele. Second one is the securitization and the shadow banking system. The development of securitization and the shadow banking system has led to non-bank financial institutions becoming formidable rivals for traditional banks. They originated loans, packaged them, and sold them as securities, bypassing banks entirely. This has resulted in a decrease in the direct role of banks in housing finance, as they lost recurring income from holding such loans. Shadow banking, mainly through investment funds and fintech companies, has further threatened by banks by offering competitive rates and a wider customer base. So for the third factor is technology advancement. Advancement in IT infrastructure have led to a decline in bank-dependent loans and a rise in the direct securities issuance. This shift has also fueled the rise of fintech companies offering innovative financial services through user-friendly digital platforms, furthering eroding banks' market share and making it harder to them to generate income from traditionally asset-based activities. So the last one is regulatory avoidance. Regulatory differences, demand and supply significantly influence the competitive environment for banks. Non-bank financial institutions and shadow banks benefit financially from relaxed regulation, boosting competition in consumer lending and mortgage financing, while traditional banks struggle with less regulated competitors.
And for the last question is question 21, which is, what factor explain the rapid growth of international banking? So the answer for question 21 is, firstly, the rapid development that occurred in international trade was due to multinational corporation that occurred in 1960. This explained when American firms operate abroad, they need banking service in foreign country to help finance international trade. For example, they might need a loan in a foreign currency to operate a factory abroad. Although this firm could use foreign bank to provide them with this international banking service, many of them prefer to do business with the US bank, which they have established a long-term relationship and which understand American business, system and practice. As international trade has grown, international banking has grown with it. Secondly, American banks have been able to make huge profit by being very active in global investment banking, where they underwrite foreign security. They also sell insurance overseas, and they make huge profit from this investment banking and insurance activity. For example, banks such as JP Morgan Chase and Goldman Sachs often help developing countries access capital from international market. The bank earn large commission from this transaction, making them one of their main source of income. Come with risks such as geopolitical instability and currency fluctuation. Therefore, American banks must continue to innovate and manage risk strategically to maintain their edge. Last but not least, the third is American banks have wanted to tap into the large pool of dollar-denominated deposit in foreign country known as euro-dollar. Euro-dollar are created when deposit in account in the United States are transferred to a bank outside the country and are kept in the form of dollar. For example of the use of euro-dollar are hedging an investment US bank using the euro-dollar market to hedge against exchange rate fluctuation or to invest in dollar-based assets abroad, as well as international trade finance, where a European company that want to buy raw material from the United States can obtain a dollar loan from a bank that utilize euro-dollar fund. The bank is able to provide loan with competitive interest rate thanks to the high liquidity in the euro-dollar market. In conclusion, the growth of international banking has been driven by the increasing globalization of trade, the expansion of investment banking and insurance activity, and the strategic use of the euro-dollar market. Banks have leveraged this factor to expand their operation and meet the growing demand for global financial service. However, as they continue to expand internationally, they must negative risks such as geopolitical uncertainties and currency fluctuation to maintain their leadership in the global financial system. That's all from us. Thank you.